We will now compare the difference between the three inventory costing methods we've just looked at. All right, so I have a column here for the units, and the numbers in this example come from the inventory costing method example question, which is the previous video. The units, as I mentioned through the previous video, the units are the same. It doesn't matter what method you're using. So the beginning inventory was 40 units, and the amount was the same for the beginning inventory, no matter what method we used. Then we had our purchases. Altogether, we had 3 different purchases, and it was 135 units, and we spent $1,875. So you'll see that that number is exactly the same, no matter what method we're using, because that's how much we've paid to buy the inventory. It doesn't matter what accounting method you use, that's what you've paid. If we add them up together, this gives us the cost of goods available for sale. So that is all of your inventory units, and that's the total money you've spent on your inventory, including the beginning inventory, plus what you purchased this month. So that number is the same. So what is different about the methods? The difference is how you allocate this total amount between the ending inventory and the cost of goods sold. So the ending inventory is 60 units, but each method will give you a different number for the ending inventory. And we have sold 115 units, and each method will give you a different cost of goods sold or cost of sales amount. Now, in this example, the cost of inventory was increasing with each purchase. What that means is every time we made a purchase, the cost per unit increased. What do you notice happens in this case when the prices are rising? Let's have a look at the numbers. Let's look at the cost of goods sold. So LIFO will give the highest cost of goods sold, and FIFO will give the lowest cost of goods sold. And the moving average will give you an amount in the middle. So why does LIFO give the highest cost of goods sold? Because remember, in this method, the last one you purchased is sold first, and the last one was the most expensive one. So you're selling your most expensive inventory first. This makes your cost of sales highest. For the FIFO method, the first one you bought is sold, and this is your cheapest inventory. So you're selling your cheapest one first, which means you have the lowest cost of goods sold. So what is the impact on the profit? Have a think about it. Pause the video. So LIFO, from up here, we said it has the highest cost of goods sold. This is an expense, so if you have the highest expense, it will give you the lowest profit. Whereas FIFO, which has the lowest cost of goods sold, an expense, will then give you the highest profit. So this situation will exist when you purchase your inventory, the cost is increasing with each purchase. If your cost of buying your inventory decreases with each purchase, then you would have the opposite situation.